Okay, well, hello everyone, and Happy New Year to all of you. Happy 2025. Some of you were on the session we just did in the last hour about longevity, where we had Adrian Roca as a guest, and we'll put out the recording of it. It was a great discussion all about your health and your longevity habits for 2025. We're going to get down to business now and talk about the apartment industry, sort of what's happening, where are we going, as best as we know. We certainly are living in an uncertain time, right? So first off, we do a lot of, as a brokerage firm, we do a lot of education. I want to show you a couple of things that we've got going here. And what we're always trying to do, by the way, is look for gaps in the market and keep the same clients. Our clients are private apartment developers. That's where our bread and butter is. That's who we work for. And we're doing a session on February 5th. And it's the first time I've ever talked about this topic of how do you, a lot of you are Gen 1 developers, or maybe you're, maybe Gen 2 developers, but how do you get the next generation, i.e. your children, okay? And I'm not talking about staff here, I'm talking about your children, right? How do you get them to come into your business, right? And how do you motivate them to do it? And what are the challenges, the opportunities, and the standard operating practices, okay? So that is February 5th. Every quarter, and our next session is starting on February 11th. So 4 times a year, we run 7 online sessions for training your leasing staff. I'm going to talk a little about occupancy rates a little bit later on, but there are challenges with occupancy today. A year ago, we weren't talking about vacancies and concessions and things like that. Today, we are. Okay, and so this is the training of your frontline staff, who are the revenue generators for your business. There's QR codes there if you want to put it in and get some of the details. Once a year, we run a significant conference. This year it was on December 2nd at the Metro Toronto Convention Center, part of Real Estate Forum. I'm going to go over a couple of the highlights for that. Sorry, that was December 3rd. Next year, mark your calendars, Tuesday, December 2nd, 2025. It'll be at Metro Toronto Convention, at the Toronto Convention Center. And we talk about everything to do with apartment development, and including affordable housing, which is becoming more and more of a factor into the future of apartment development. Okay, that's what we got going on. You can see the topics here today. This is what I'm going to try and cover in the next 45 minutes to an hour. Okay, okay, Rod, next slide. So we ran our annual conference, and these were the topics that we, that we talked about. And generally, I would say that it was an upbeat conference, because apartments by nature have done better than every other asset class. I can't imagine what an office conference would look like, okay, or a land conference would look like today. Places where there's real strain and real pressure and things like that. But we had a couple of political people speak. We don't often get political people speaking, but we had Councillor Bradford from the City of Toronto. We had Jennifer Keesmaat, who was the former planner for the City of Toronto. People had different opinions, but there were lots and lots of good side conversations. And coming out to conferences, a lot of what happens in the hallway with the people at your table, in the discussions and so on, is a significant part of the value. And that's the thing that we notice when you get developers together from different parts of the country in different areas. They have great conversations. So we do need to build a lot of affordable housing in Canada. We have a defined crisis. It's not a housing crisis, it's a housing affordability crisis. We spend a fair bit of time talking about joint venture structures. I'm actually going to show you a joint venture structure a little bit later on, and how developers can raise money. We are in the business of raising money and putting together joint ventures. Right now, it's for Canadian money going to the US to build apartments, and I'll show you what that structure looks like and who gets what, and how the developers paid, how the partners are paid, who takes the risk, and things like that. We talked a lot about financing. CMHC is always a topic that you spend a lot of time on. And we talked a lot about the MLI Select program and the benefits and the challenges of it. The missing middle, Rod Cholhauser, our Director of Marketing, also is the President of the Self-Funding House. We walked through some examples of how not just apartment builders, but home builders can be part of the solution. I'm going to show you an example of that. We always talk about feasibility studies. That's what we do in our business. When developers first get the idea of building, I think for one of the first times we talked about just what is rent, the science behind rent, what drives rent, what happens to rent in a recession. We talked a little bit about that today. And then the final one we talked about was we talked about long-term apartment ownership and taxation. The biggest bill you're ever going to pay in your apartment building is the tax on your profit. And most developers don't spend enough time thinking about what does their corporate structure look like now for the future payout that they get 5, 10, 15, or 50 years down the road. And we think that that's something that really is not talked about enough. And we had two accountants come on and talk about it in a fairly basic way, but it's a complex area, but we addressed it. Okay, next slide, Rod. I want to talk about apartment development, and I mentioned earlier that all our clients are private developers, and private developers are people, they think with emotion, and a lot of life, whether I'm going to take a risk, not depends on the data, but it also depends on the feeling that I have, right? And so I would say that I've had 250 conversations with apartment developers, financiers, and just people in the apartment development business. And I boiled it down to 7 mindsets that developers have. Okay. And I'm going to put a number to each one just for fun, just to give some perspective to it. So I would say that and remember in the apartment business, we went from the COVID fog into the interest rate fog. So other people, if you're in the pharmaceutical business, you just had the COVID fog. If you were in the automobile business, but this is an interest sensitive business. So we went from the COVID fog, things cleared up a little, then we went to the interest rate fog. And I think now we are heading into a recession fog. Okay. So it hasn't been clear since this thing started, right? And so maybe it hasn't been clear since COVID started. We're getting on 3, 4, 5 years of uncertainty, and maybe that uncertainty continues. So when there's uncertainty, quite frankly, maybe the easiest decision to make is the one where you pause. And so you're sailing a ship from Halifax to London, England, and all of a sudden there's a fog and your instruments fail. Well, what is the most logical thing to do? The logical thing to do maybe is just to pause. And I think a lot of people have paused in their development. I would say the closer you are to Toronto, the more you pause. Doesn't mean everyone stopped, and the further away you are from Toronto, probably the less you paused, although there's still some pausing going on, just because the impacts as you got to high-rise, dense, higher development charges, things like that, caused you maybe to pause. And those rents were also the ones that the higher the rents go, the more that they can come up. I'm going to guess, I don't know, 50, 60% of people who were planning on building apartments, I'm not saying they're not going to build them, but they've generally just paused. Okay, that's the number one mindset. Number two mindset, you're building for the long term. And quite frankly, if you can afford to do this, this is the strategy that builds wealth as well as anything in real estate development. So if you're a long-term apartment builder and you've got money, you know this. You built a building 40 years ago for $10 million. Today, it's probably worth $100 million. Okay. And if you build a building for $10 million today, probably in less than 40 years from now, it'll be worth $100 million, given where I think inflation is going to go. Okay. So apartments are a great long-term investment. They pay themselves off. You can refinance them, take out your money, tax-free. You can depreciate it down to zero, et cetera, et cetera. And I always point out that, every apartment developer who built in the 60s and kept his product is extraordinarily wealthy today. Every condo developer in the 60s and 70s made his money, paid his tax, and he's probably left the business. Fair enough? And so long-term, so if you build for the long term, then those people are still building today. There are, I'm going to guess, 20, 30, 40 of them in Canada. I don't think they watch the news. I think they have machines built. They love apartments. They build 1 or 2 buildings a year. They keep them. And over time, they may not be that profitable when you first build them, but over time, you become very, very wealthy in the apartment business. So that's the second one. The third one is similar to number 2, except they don't have the same financial depth and they don't have the same amount of money. So this is it's a totally legitimate place to be. I think it's an apartment developer who says, I'm building an apartment right now. I know my returns are skinny, but I believe the apartment story. Okay. And the apartment story is there's a shortage. Generally, rents are going up, interest rates will come down, and construction costs, land costs have come down, and construction costs may come down. So while my margin today is skinny, I'm building into something that is getting better. I think that is a reasonable assumption to make. But the only challenge that these guys have is that they may not have the money to do this. And then going to a joint venture structure is probably a logical thing to do. There is a lot of money sitting on the sidelines looking for a home. At Rock Advisors, we believe part of our mission is to take that money sitting on the sidelines and show it a home in apartment development in both Canada and the US. Okay, so believing in the story, similar to number two, but you don't have the financial strength to build it, hold it for 40 years. You need a joint venture partner. Okay. The fourth one, this is the developer who's just built for fees. This one's a little bit of a scary one. So it's a developer who is, let's say, a capable developer, but they have like no money. And so you got $100 million building, you go and get $75 million in construction financing, you get a mezzanine loan for 15 million, now you're 90 million, you syndicate your 10 million, so you get 8 million from an equity partner, and then you borrow the 2 million from family and friends. So you don't have a lot of money. They're building for fees, a construction fee, a development fee. You know, if time and luck and timing work against you here, then that developer may be over his skis today, because everything was going good when interest rates were low, construction costs were low, and cap rates were lower. They haven't changed that much. I'll talk about that later, but they were essentially kind of building for fees and hoped to make a profit. Right now, there have not been a lot of failures, partially because rents moved up a lot in the last 2 or 3 years. Even although construction costs and interest rates went up, I'm not saying the developer made the same profit he penciled out when he first started construction, but there was enough juice in the deal that they were able to build it. Maybe they monetized their land, maybe they got a construction fee, maybe they got a development fee and a little bit of profit. But the guy who's just building for fees, that's a business where everything needs to go in the right direction. And a few of them got over their skis and the lenders have stepped in and taken them back. But the lenders don't want the buildings back. A lot of them have continued to sort of extend and pretend. I don't know if the pain is over, but I would guess that the pain was nowhere near what we thought it was going to be. The real pain has showed up in land, probably. Yeah, land. It's always land, and probably in office as we see more and more transactions. So there are those guys, and I think that guy who builds for fees right now probably has to be on the sidelines, because the numbers just aren't there, and the investors aren't there for that skinny margin project. Okay. Number 5, I make the assumption again, nobody is one of these categories, you're a combination of them. Some developers who have built organizations, they've got staff, maybe their children are in the business and so on. They're just building smaller buildings and they're building slower, right? And it's like saying, look, I love this business, makes sense long term, but things look a little foggy. I don't know if I want to start a 400 unit high-rise building or something along that lines. I'd rather build smaller buildings, and quite frankly, maybe I'll go slower. Let me give you an example to illustrate what I mean by building smaller and slower. I've got a choice. I can build one 240 unit building, or I could build 4 60 unit buildings, 240 units again, but in 4 buildings, right? It's not the same, but if I had a choice and I'm a developer, I kind of think I'd be leaning towards building 4 60 unit buildings as opposed to one 240 unit building. I don't want to put all my eggs in one basket. It's going to take so much longer to build that high rise. Sometimes it's like, man, it's a year down before you can come back up again with the underground garage if it's multiple levels of parking and things like that. So maybe I'm going to build 4 60 unit buildings. And instead of building them sequentially, I might break ground and 6 months later start digging the second hole, then the third hole, the fourth hole. Maybe I'm just going to build one of those buildings. I'm going to stabilize it. I'm going to refinance it. And I go, okay, went well. Then I'm going to start the second building. May not be as efficient, may not be as profitable, but what I'm trying to do here is manage risk. So we're seeing developers, if they're continuing to build, thinking smaller, not being as aggressive, going slower, that costs you money, but it's also maybe minimizing your risk. I think the marketplace is, a little bit risk off. But that being said, it's not that bad out there, and I'll talk about that a little bit later on. Okay, so that's number 5. Number 6, I think this is a very valid strategy for a long-term apartment developer. Use this time to build a better company. Look, for the last number of years, land was expensive, staff was hard to hire, and contractors weren't calling you back. All 3 of those things have changed. Land is cheaper, contractors are calling you back, and staff are available. Okay, maybe this is the time, and again, this is all about capitalization and having the money to do it. We'll talk a little bit about joint ventures later on, but maybe this is a good time to build a company. Fair enough. And a company that builds apartments. You're a widget maker, you stamp out apartments. And I've been looking at a lot of developers, and the more programmatic a developer gets, the more he builds the same product over and over again and becomes a widget maker. Rinse and repeat is a very, very good formula for building apartments. Okay, you take all the surprise out of everything. Every building you build, you get smarter, but you just keep stamping it out. Okay, I'll talk more about that later. So use the time to build a pyramid. And the last one, number 7, is it's kind of my thesis, but I think it's well grounded, and that is prepare for an affordable housing boom, an affordable housing apartment rental boom. And here is my thesis, and love to have a discussion with any of you if you want to do it offline about this. I think we've come through the COVID crisis, and that's the key word, is crisis. Unimaginable amounts of money were thrown at the problem till we solved it. And there was never a question. There was no, just we threw money at COVID till we solved it. We paid whatever we paid for vaccines, et cetera, et cetera, et cetera, right? I would say that we have another crisis, whether there is one or not, the climate crisis. Okay, we are throwing money at it head first, foolishly sometimes, but it's a crisis and we're spending money, right? We now have the word housing and crisis put together. Every politician talks about a housing crisis. I think that at the end of the day, we had to solve the COVID crisis. Fair enough. I think today that we are going to see more and more government getting their act together to make affordable housing work. I would say that if you took every program across the country, you took the CMHC program, you took the the tax abatement program in Winnipeg, the enterprise zone program in Hamilton, and the deferral of development fees in Markham. If you could stack all those up in one place, you could build apartments. Fair enough. But what we have is a haphazard dog's breakfast of policy for apartment development federally, provincially, municipally, CRA-wise, and CMHC-wise. Fair enough. If all those agencies could get their ducks lined up, and because we have a crisis, maybe they will, there is plenty of opportunity to build affordable housing. Just a couple of simple changes. If we bring in if we bring back the MERB program, there's a great program around in the 80s, allow you right off your soft costs. Okay, doctors and dentists and so on will jump into it for that soft cost deduction that they get in year 1. If we brought in 1031 rollovers that the US has, where you can build an apartment, sell it, take all your money and roll into another deal and pay no tax. Here, you make $10 million, you might pay 4 or 5 million in tax, you only got 6 million to roll into the deal. If that were the case, you have 10 million to roll in the deal, right? So I think that eventually government figures it out. Okay. And when they bring in government programs, they are typically not well planned, and there are opportunities, loopholes, bad legislation that allows you to get a better deal than as time goes on and they sort of figure it out. I think the MLI Select program is like that. They've tightened up on it a lot, but if you got in early, then maybe you got better deals that are available today. People, sometimes when I give them this thesis, sort of say, no, Derek, government's never going to figure it out. City Hall has been worse every year for the last 25 years. Why do you think they're all of a sudden magically going to get better? I think because they're going to have to get better, right? Because this problem continues and there's really no end in sight. Whatever housing crisis we have today will be worse next year and be worse the year after. This is like a ship. It takes a long time to turn around. It's like a big cruise ship versus a speedboat. So I think that there's going to be significant opportunity to build affordable housing in the future, and it's coming. I'm no fan of government. 100% government should be backing out, but I think I'll give the example, and I'm a conservative, right-wing Donald Trump guy. Okay, I don't believe that we should have more government. I think we should have less government. I think we need to cut it and so on. But the problem here is that government needs to back out, and that's the work that they've got to do, right? Yeah, a little bit off track here. Anyways, so I think that we will eventually figure this out. Let me give you the example of a positive move that we made for new apartment construction that was implemented in the wrong way, typical of government. The removal of the HST on new apartment construction. Good idea. Good idea. But you know, the way it was implemented, if you had started construction already, you didn't get it. So the guy who took the risk and moved ahead didn't get it, right? And it's only a 5-year program. So if I start, I think it's already 2 years old. If I start today and buy a raw piece of land and go through the zoning process, that program will be over by the time I get there, right? So it's just short-sighted of government and putting in these little band-aids. Someone, I don't know who that person is, has to come and look at the big picture and say, we need to have the same policy in place across the country with these incentives, boom, 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 boom. And I think you will see people pivot to building apartments. I think the government thinks that all we can do is throw little goodies into the water and all of a sudden people are going to come and start building apartments. This is a difficult business too. If any of you that have built an apartment building, this is not an easy thing to do. And these little here and there incentives aren't enough. We need a comprehensive program. Okay, all right, enough said about that. So preparing for a recession. We are either heading into a recession or I think we're in one. But this has been the slowest, most anticipated recession in history. Fair enough? It's like this has been coming. We've been thinking it's coming, I think it may finally be here. And whether we have it or not really isn't the issue. What I want to talk about is, what do you as an apartment owner and an apartment developer do in a recession? Because business changes. And if you're heading into recession, how should you be thinking about it? Okay. Well, the good news is that apartments have to a large extent divorced themselves from the conventional economy. Okay. If you know you're going into a recession and you're an airline or you're a hotel or you're consumer goods or things like that, you know things are going to be tough. Fair enough. If you've got a fully stabilized apartment building, cash flowing, things may get a little tough, but there's no way your building's emptying out. Fair enough. There's no way your delinquencies are going through the roof. Yeah, vacancies get a little higher, rent increases come off, you have the delinquency here and there. But that is the beauty of the apartment business. It is the steady Eddie, stable performer for the most part. The greatest danger to apartments is not recession. Okay? I wonder if any can even just pop it into the chat room. What do you believe the greatest danger to the apartment industry is? You know, it's not interest rates either, right? It can affect some people, but the greatest danger to apartments is overbuilding. It's overbuilding. It's not recession. The time you see apartments get into trouble, and there's really nowhere in Canada that's overbuilt. Many places in the US overbuilt. Austin, Texas is massively overbuilt. People who put in money in those markets that lose it all or only get back half of it, because overbuilding causes rents to go down, lots of product for sale and things like that. So let's talk about this idea of preparing for a recession. Rod, next slide. And I think that, yeah, maybe you want to go kind of full, yeah, I don't know what your view is. You just go full screen because I'm going to talk about this for a bit. Okay. The problem with the recession is things get more difficult. So for example, there are going to be acquisition opportunities. Okay. Owners are going to face cash flow situations, and lenders may run out of patience, but they're not simple deals to do. We're working now on several deals where we are trading land for an apartment building plus cash. One guy needs to get out and be happy to take an apartment building that's cash flowing plus some cash to land balance it or something like that. So we can see more real estate exchanges with some cash rebalancing as there's problems, but you can solve the problem and get liquidity for people, but not in the typical sense. Number two, in a recession, new apartment construction lease ups do get harder. They do not, they're not impossible, but they get harder. So if you've got a newly constructed apartment building and it's full, I think you can probably, you're probably going to be fine. Okay. You're probably going to be fine. But if you're leasing up a new building and you're just coming to market today and the recession rolls out badly, then it's going to be tricky to get that building full. Okay. And you're going to have to work much harder than you had to work, let's say, a year ago if you started. Okay. Now, if we hit a recession, and I've been through a number of recessions across North America because we worked in Yellowknife when the diamond mine shut down, we worked in Gander when the airport, and we worked in Dallas. And it's not just a homogeneous recession occurs. Some places are booming while other places are suffering, right? What we generally see is the A quality product gets hurt the most. Fair enough? So you'll see the rents at the top end of the market come off, okay? If those rents come off enough, they then put pressure on the B market. So if that differential between an A apartment and a B apartment were $1,000, then it's not a problem. But if that A rent drops by $700 and now it's a $300 difference, right? Then that B guy may be able to move up to an A product. Make sense? So A gets hit first. If it's severe enough and long enough, then it starts impacting B rents. C rents, by and large, generally stay stable. Okay, those are not people who are going anywhere else. They were renters by need, not by choice. And C gets hurt the least. But on the other side of it, when you start coming out of the recession, A comes back faster than B. Fair enough? Kind of makes sense. A goes into the tank faster, but it comes back faster. If A stays in trouble long enough, then it starts affecting the B, right? So what my advice to you is, if you are an apartment owner and you start seeing vacancies, and maybe you are going to start seeing them or softness in the market, don't fall behind, okay? Let me give you this analogy. Two families are driving a car from Toronto to Ottawa, and they're kind of following each other. And one family stops for an unscheduled restroom break. And that break takes 10 minutes. It takes a long time for that family who stopped to catch up to that family who didn't stop. Do you see the analogy, the point I'm trying to make? Right? Just don't make that up. So if you find yourself with a 1,000-unit portfolio and you've normally got 10 to 20 empty apartments, which would be a reasonable number to be carrying, and all of a sudden you see yourself going to 30 or 40 or 50, you're on your way to a problem. You just made an unscheduled stop. Fair enough? It's going to take a long time to catch up. And what I say to owners, particularly of large buildings, don't let yourself fall behind. Do what you have to do, marketing, concessions, longer office hours, making deals, focus on your backdoor and retention. But as you fall behind, and the more you fall behind, the harder it is to catch up. And that is hard learned lessons that I've learned over the last 35 years in renting apartments. Okay. Bigger buildings, they get behind, suffer, and it gets very, very hard to pull them back again. Okay. All right, next slide. I want to talk a little bit about cap rates, and we got full slide cap rates, and maybe where they're going and the lessons learned from the last couple of years. First of all, I think that the stability of apartments really showed up in the last few years, in that while interest rates went up, and I'll talk about that in a minute, cap rates didn't change very much. Okay. And that is due to the fact that apartment buildings are stable, apartment owners are by and large stable, and they were not going to sell much cheaper than because interest rates went up. So let's do a bit of an analysis on what a cap rate is and how interest rate affects it. And I think the conclusion you'll get from this will be, I hope, valuable to you. Okay. So the yellow line, by the way, this is US data, which I got from an apartment economist named Ron Whitten. There is no Canadian data like this. There aren't enough transactions, there aren't enough services and so on. But I want you to think about the relative differences between these numbers, not the actual number. And we don't want to debate that. Okay. So buyer IRR targets is the yellow line from the year 2000 till now, with some projection out for 25. Okay. And you can see that buyer IRR targets have been moving down, just apartments got more valuable, interest rates have gone down, and so on. So that's the yellow line, just generally trending down. The next line is apartment cap rates. Okay. Cap rate, NOI over total price. So you can see that buyer IRR targets and cap rates follow each other almost perfectly. It's almost a 1-to-1 ratio. It's almost like it's different sides of the same coin. Okay. And so there's a 1-to-1 correlation between buyer targets and IRR and cap rates. Now, the blue line, what I want you to look at is the relative difference between the green line, apartment cap rates, everything that you guys watch. And first question you ask me as a broker is, what's the cap rate, right? Well, my answer is it's got a 4 in front of it, okay, as a starting point, right? So now look at the relationship between cap rates and interest rates, okay? So the blue line is the 10-year US Treasury, a proxy for interest rates. And what you will see is that there is not a high correlation between interest rate and cap rates. So when interest rates started going up, and they went up significantly, cap rates moved a little, but nowhere near. I mean, interest rates went up, 400 bips or more than that, yet cap rates hardly changed. Fair enough? Cap rates hardly changed. And so what did change was the number of transactions. So when there's so look at the spread now between the green line and the blue line. At some times, you'll see the spread is very small right there. And Rod, go back to around, 2006, you'll see the same thing, right? There, it's very large. Other times, it's very small, right? So when the gap is very large, that is a good time to buy apartments. Fair enough? I'm buying apartments at a 4 cap rate. Interest rates are 2%. I got a 200-point spread. Okay. So what we measure in this chart here is the spread between the green line and the blue line, and that's shown in the bar chart along the bottom. Okay. So when the spread is high, there's lots of gravy in there for everyone. The seller gets a good price, the buyer gets a good yield because the cost of money is cheaper. When those two numbers get very close together, as they are now, okay, what you're going to see is probably lower transactions. And the bigger the differential between the green line and the blue line, the more transactions you're going to get. So I mentioned the correlation between the yellow line, IRR target, and cap rates is 1-to-1. So the correlation between cap rate and interest rates is only 0.62. Okay? And that's 0.62 directionally. So what that means is about 62% of the time, when interest rates move up, cap rates move up in direction only, not in quantum. Okay. So what that also means is about a third of the time, interest rates go up, cap rates don't. They're not highly correlated. They're somewhat correlated. Okay. I believe the other parts of it are investor sentiment, what's going on in the economy, safety, and things like that. Right. I mean, in Europe, there was a time when interest rates were negative and people still put their money in the bank because they didn't know where else to put it. Fair enough. So you got to think about this thing here. So cap rates they went up a little. They're staying up. What is a cap rate today? It's going to depend very much on the age of the building, blah, blah, blah. But I would say that most cap rates today have a 4 in front of it. Fair enough? And unless there's an extraordinary circumstance, well, it's certainly going to be 5 in front of it, but I think having less than a 4 in front of it would probably have extraordinary circumstances, like, well, really extraordinary financing in place for a long time, you know, and things like that. So that's kind of what I wanted to say about cap rates, that the effective interest rates is more muted than people think. The data shows us that. It's a good thing to know. Apartment transactions are coming back. Okay. I would say that in 20, let's think about the years that have gone by. 2022, most people would say was a relatively good year. I would beg to differ. I would say the first half of 2022 was good. The second half of 2022 was lousy. But when we combine the two, it kind of came out as a good year. Okay. 2023, 2024 have been tougher years. I suspect, nobody knows, I don't, you don't, but the 2025, if I'm guessing, is not necessarily going to be a great year. Okay, but it could be a great year for you if you think outside the box and you start thinking differently than everybody else. Us as brokers, we are not just going cash for real estate. We are going cash to mortgage, to trading, to VTBs, to just a whole bunch of creative ways to structure a deal. Okay, but the good news is, doesn't matter what happens with the economy. Apartments have divorced themselves from the conventional market, and you don't have to suffer if we go into a downturn. This is the overall real estate cycle that people follow. My guess is that, you know, Ontario might be that pink arrow I show there, but if I were doing this summer in Alberta, they would see impatience, excitement, and overconfidence, right? So it all depends. This is not a one snapshot thing for a country, a province, or a city. In America, there are certain parts of America that are doing extraordinarily well, and there are other parts of America that aren't doing as well. The same is true for Canada, with Alberta being, you know, a very different place than I think Ontario is right now. Real estate is a local business. Okay. Okay, next slide. So I want to talk about something that has become quite passionate for Rod and I, and that is this idea of helping solve the affordable housing crisis. There is no one answer to this problem, okay? And this affordable housing crisis also relates to home ownership. So rents are high. By the way, we're seeing way more roommates. If anybody has seen that, just pop it into the chat room. We are seeing a lot more roommates, but it's a statistic that nobody really tracks. CMHC doesn't track it and so on. But I think that the affordability problem is showing up in your renter profile, that whereas one person used to rent an apartment before, now 2 people are renting it. Okay. So I would say that if you're in Toronto, I know this, and you've got 3-bedroom apartments that you initially designed for families, that 3-bedroom apartment today is not rented by a family. That 3-bedroom apartment might be $4,500, by the way. Okay, it's probably rented by 3 roommates paying $1,500 each, and they're taking no parking. So I've seen situations now where there's actually more parking. There's more empty parking than I thought there would be. And the 3-bedroom, instead of being the richest person in the building, is the poorest person in the building. Everybody get it? Right? So things have flipped a little bit and they've taken no parking. Maybe the 3-bedroom of the future is 3 equal size apartments with 3 ensuite bathrooms, a little bit like student housing, because given the pricing and the price of housing has not kept up with the, with people's incomes, and people are sharing a lot more. That has all kinds of other implications in terms of joint and severable leases, wear and tear on the building, more turnover, and things like that, right? So how do we fix this problem? Well, there's multiple ways to fix it. There's multiple problems. But one of the things that Rod and I are doing is combining sort of our knowledge of apartments and rentals, our knowledge of home ownership, and then our knowledge of the rental process. And we're combining that into something that we call the self-funding house. And what we need really is a mind shift of young people. I'm going to argue, some of you on this call, if you're in your 50s and your 60s, you think about the first house you bought, it was probably 3 times your income. Fair enough? So my first house was like $80,000. I think I was making $30,000 a year. It was $85,000. It was about 3 times my income. Okay. Today, if I'm a regular working guy and I am making $60,000 per year or something like that, I might need 10 to 15 times that income to buy that same house. Okay. So it's become very difficult for young people to buy houses, and that is a detriment to our society. Okay. We want young people to own houses. You're in the game. You have skin in the game. You're a better citizen in the long run if you afford a home. Of course, some people have to rent, et cetera, et cetera. You get it, right? So when Rod and I looked at the numbers, and this came from a book that we wrote called The Self-Funding House. It's available on Amazon. We're happy to send you an e-copy of it if you request it. The purpose of this book is to change the way people think about housing. So if the average house in Canada it's $750,000. Now that's across the average New Brunswick and Prince Edward Island and Toronto and Alberta and so on. The average price of a house is around $750,000. Okay. At today's interest rates, if you want to live in that house by yourself, you need an income of $180,000, right? Family income. That is out of reach for a lot of young people. Okay. To combine $180,000. But what if you did this? What if you built a legal accessory dwelling unit, fireproof, soundproof, and so on, built the code, which you are now allowed to build legally, and you live in the basement apartment? By the way, like I did when I was 23 years old. So this book, The Self-Funding House, is a little bit autobiographical. Okay. There were a lot of jokes made in my wedding about where my bride was going to live when she first married me, in the basement. Okay. But I got to tell you that it was the beginning of my real estate career and the foundation of my you know my financial strength. So if you live upstairs and you rent out the basement apartment, I jumped ahead here, your income requirement drops to 117,000. And we have found lenders who will recognize that income upstairs and count it towards your mortgage payment dollar for dollar. So you own the same house, but now you're in the game. Sure, you're renting out the basement, but now your income has dropped to $117,000. Okay. Now, what if you changed it and did what I did when I was 24? I lived in the basement. I rent out the upstairs. Okay. So I rent out the upstairs. In this case here, the math that we used was about $3,000 for the upstairs, $1,500 for the basement. So now I live downstairs, but I own the place. I rented the upstairs for $3,000. My income requirement drops to $60,000. You still got the down payment problem. You still got to come with a down payment. Well, we talk about solutions to the down payment problem also. So we think by doing this, first of all, it doesn't involve government. It puts young people into houses, and it creates rental housing at the low end of the market. This is the cheapest rent you can find is a basement apartment. Or you just buy the house, you rent both the upstairs and the downstairs. And there have been a number of changes in legislation now that allow this to be built almost anywhere, well, certainly anywhere in Ontario, right? You still got setbacks and things like that, but it's no longer that your neighbor can oppose you and you've got to go through, all kinds of zoning ups and downs here, right? So put together a program. Our clients so far, like we just got started, our clients so far built 100 of these, okay? And our clients are in Ontario and Alberta. We think that thousands of these could be built, and it combines our knowledge of, people, renters, making investments and creating rental housing at the same time. Right, let's go on the next slide. If any of you are interested in this, the guy to reach out to is Rod Schulheiser. And we've created programs for the design of the house, for how your agents sell it. You're not selling a house here. You are selling a small business in a sense, right? And we think this is great for young people as a way to afford a home, to have skin in the game, as well as to just be able to afford a house when they can't. Part of housing, it seems to me, and it seems to Rod, is that you just have to be in the game. If you had bought a house 10 years ago, you're a young person at 25, it wouldn't matter what you pay. You'd be carried along in the market. And now at 35, you'd have a house, maybe not the perfect house, but you built some equity, right? If you didn't, now at 35, it's so much harder to get in. So it seems to me, and history has been consistent in that, just getting into the business. So we're working with municipalities, financial institutions, they're slow to move, property management companies to actually manage these for investors and so on. And we call this concept the self-funding house. The numbers are really, really very, very compelling. Okay. Last thing that we're doing, and I want to talk about diversification. There is a lot of money sitting on the sidelines right now. There are hundreds of millions of dollars, and I'm talking about like individual clients who have a lot of money sitting on the sidelines, and they have concerns about Canada. They should be getting diversification in their investments, and they are apartment people. All our clients are private apartment developers, many of them, and apartment owners. Many of them have tens and hundreds of millions of dollars sitting on the sideline. They'd like to put that money to work. So we started thinking about what would be a good place to put that money. And 3 or 4 bullet points on our thesis. We think that in the United States, first of all, we wanted to go with a programmatic developer. That is, the developer built the same product over and over and over again. We didn't want to be, adjusting buildings to, small sites and doing all kinds of zoning issues. We wanted simple construction that a developer had built already, that he could show me 5 projects that he's already built. Fair enough. And we wanted the construction to be simple, repeatable, and programmatic. So, and then we wanted a developer that had construction, development, property management, and investor reporting in-house. So that's going to be a relatively large developer. Fair enough. So we know the kind of product we wanted, simple construction. In the conclusion we came to was 3-story wood walk-up, 100% efficient buildings with breezeways in them, no hallways and so on, was the product we wanted. And we wanted a developer who was fully integrated. That was what I understood and wanted. Then we had to decide where. Okay. And the where is a thesis that we've come up with through our research, and I'll tell you what that thesis is. So we like the United States for diversification. For many, many reasons, we like the United States. You can do the same thing in Canada, but there's a real shortage of programmatic developers that we found in the US. You're sitting here in Canada looking down at 50 states. It's just too many. It's like 50 little countries, right? So what I did is very simple. I just eliminated all the blue states. Just if it were a Democratic state, and most developers are Republican by nature. They go, yeah, I get it. So we eliminated all the blue states. That got rid of half the states, okay? Mainly on the coast, California, New York, Massachusetts, and so on, right? So then we said, okay, we're left with about 20, 25 red states. I combined, so we grouped the red states into 3 categories. There were the states in the middle of the US, Wyoming, North Dakota, South Dakota, Idaho, Montana, places like that. Great places, they really are, but there's hardly anybody there. It's kind of like Saskatchewan, right? Cheyenne, the capital of Wyoming, has 63,000 people. That's not even Brantford, right? So while they're great places, they're not big enough to invest in. So we took out a third. Remember, we got rid of all the blue states. Now we got rid of the sparsely populated states. Then I did something that people thought was bold. I eliminated the most popular place to invest, the Sun Belt. Okay, Florida, Texas, the Carolinas, Arizona. And the reason I eliminated them is because everybody is piling in there. They're getting overbuilt. I think earlier I said overbuilding is the greatest danger we face, right? And so I eliminated those states. And by the way, those are great states, Florida and Texas and so on. But it's all about timing. You've got to get in at the right time. If you get in too late, they get overbuilt, then you go to that next cycle again. Austin is overbuilt. Nashville is overbuilt. Dallas is probably overbuilt, right? So you don't want to be entering those markets, and all the big guys are there. So if I've eliminated the blue states, eliminated the central sparsely populated states, eliminated the Sun Belt, what's left? Well, what's left is the Midwestern United States. The red states, Indiana, Ohio, Kentucky, Missouri, and so on. If you think about North America, this is the last part of my thesis. If you think about North America, and you think about private developers, so I'm taking basically money from high net worth Canadian clients to the US to invest. And for private people, It's much more about the sentiment and how they feel about the developer. You still got to have the returns. But the point I'm making is culture flows north, south, not east, west. And I haven't heard this very often, but it makes complete sense. If you were to take all the lines off the map in North America, the countries, the states, the provinces, and you were to redraw the lines, I'm going to argue you would have 6 countries. You would have a country that I call Cascadia, and that would be Vancouver, right? Vancouver down to, don't advertise something on here, guys. So 8.4% cap rate, holy smoke. Okay, so Cascadia, right? You're going down from Vancouver, Oregon, Washington, and California, right? The culture is the same. I would say from Alberta down to Texas, the culture is the same. You got to leave Quebec out. You got to leave New York and the East Coast. So that's a different hard ass mentality. But I think the culture as you go down from Ontario into the central US, the manufacturing, former Rust Belt, and the re-industrialization of America, the deglobalization is all happening along in the Midwest United States, along the rivers, along the railroads, near the airports, near the educational institutions, right? And so we see a real resurgence of the Midwestern United States, not high paying jobs, but lots and lots of lower end manufacturing jobs. And we are taking money, right? Next slide. We're taking Canadian private equity to the US. So the point that I'm making here is that whatever is going on right now in the Canadian economy, in the US economy, there are always opportunities there. You just have to look. And we as brokers, when we saw that brokerage was dropping off and it dropped off significantly, it's coming back. We had clients, we had staff, we put the idea together saying, start raising private equity. We started recapitalizing deals in Canada and we couldn't find enough of them with programmatic developers, and that led us to the US. That led us to our thesis. So we capitalized our first deal. It's already closed and it's under construction outside of Indianapolis. It was so fast. I mean, we wired the money into the developer's account on January 10th, and by June 10th, by June 30th, they were scraping ground already, right? It's already like, the clubhouse and 3 of the buildings have already foundations in, they're already framing, right? And the first buildings will be ready 13 months after we wired the check into the developer's account. So it's a very, very different business. Let me show you just how these deals are structured, okay? And I think that if you want to be an apartment developer, and there's lots of opportunity coming, okay, is structuring a deal something like this might make sense, okay? So you got a project that is $70 million total cost, okay? You got a local lender to give you $49 million or 70% loan to cost. We are not looking for high leverage, by the way, okay? We don't want to place a mezzanine loan on top of that, because if things go a little sideways, we want to have some equity in this deal, okay? We want to be very cautious. Foreign investors are way more conservative than the local guy, right? So, and then you need investors to raise $21 million, fair enough, of which the developer is part of the investor group. Make sense? So it's a limited partnership. The developer is the general partner, the property manager, and the constructor. He's also an investor. So of the $21 million, we asked that the developer have at least 10% of the deal. So in this case here, the developer would have, $2 million in the deal. We put $19 million in the deal. The deal would then be built. The developer has given us a guaranteed maximum price. Okay, let's say the whole project's gonna, construction cost is gonna be maybe $50 million. Okay. And then the building is built by the developer with this guaranteed maximum price. The developer's name, his covenant is on that $49 million loan. Everybody with me? Okay, so it's called a safety first clause. Okay, then the deal is built, stabilized, and it's either refinanced or it's sold. It's going to take 4 years. When it's sold, so whatever money is put in the deal, that $21 million, that you can see in the blue box below, there's an 8% pref return paid on that money, and that's cumulative. So if I put in $19 million and the deal is sold, I'm going to get my $19 million back and I'm going to get an 8% return on that money. Okay. First. And the other investor, the developer put in the 2 million, he'll get 8% on his money first. So once that's returned, so the loan is paid off and the investors get their money back, the 8% pref is done, and then the money is split 70-30. So my investor gets 70%, the developer gets 30%. That's the developer's promote, right? So they get a construction fee, a management, a development fee, a property management fee. All that's real work that has to get done. You don't want them getting rich on it, but they got to keep the lights on. And then everybody gets their money back at an 8% pref, and then the money is split 70-30. So remember, the developer only put in 10% of the equity, and now he's getting 30% of the profit. So that's the developer's lift, right? And these are straightforward, simple deals to project. We know the rents are $1.80 a foot. We think that it's reasonable that our investor will get a 24% IRR, or they'll get about a 2.5x of their money. So they put $1 million today, they should be able to get $2.5 million out in about 4 years from now, and what we think is a relatively safe business. It's not Bitcoin returns, but it's a business that we understand and our client understands. It's a perfect business for people who are in the apartment business, but they're tired of swinging the hammer and they're tired of having a plunger in their hand. So they want to become an investor and they want to get active returns, but they want to be passive. Dave Price is on this call, our director of sales. I'll be happy to talk to you about it and show you the example of a deal. But really what we're saying here is that there's opportunities everywhere. And right now, raising money is difficult. And you as an investor, if you are that, then your ability to find deals, choose a deal, and select a deal is and get a better and negotiate something better with the developer is probably better than it has been, than it was 3, 4, 5 years ago or something like that. So that is the update on the apartment marketplace. We're probably, nobody knows, but we're guessing. And a lot of smart people are saying that we're heading into a difficult 2025, but it doesn't have to be difficult for the apartment business because of the nature of the business. So thanks for joining us. We do events throughout the year, and if you're on our mailing list, we look forward to seeing you again. Okay, Rod, we're done. Happy New Year, everybody, and a recording of this will also be available. Thank you. Dave Price, put your hand up there, Dave. Oh, he's gone. There he is. Yeah, Dave Price is our director of sales, and if you're interested in talking about the U.S. market, Dave's the guy to talk to. Thank you so much, everyone. All the best.